All right, let's dive in. We're going to tackle something that every single business in New Zealand has to deal with, the goods and services tax. You know it is GST, and we're going to make it make sense. So this number probably looks pretty familiar. 15%. It feels like it's everywhere, right? It's kind of the star of the show when we talk about GST. But, and this is a big but, it's really just the opening act. I mean, think about it. For Kiwi businesses, this three-letter word, GST, is woven into pretty much everything you do. Buying, selling, you name it, GST is probably there. Okay, but what about when that simple 15% rule just doesn't fit? And trust me, that happens more than you'd think. This is where GST can start to feel like a tricky maze. You've got your main path, sure, but then there are all these detours and hidden turns. So what we're going to do is walk through this maze together, step by step. So first things first, let's stick to that main path. This is the super highway of GST, the one you'll be on for like 90% of your journey. We're talking about the standard 15% rule. So here's the deal, plain and simple. If you're a GST registered business in New Zealand, you add 15% to most of the goods and services you sell. This is what's called the standard rate. It's your default setting, your go-to. Easy peasy, right? Well, mostly. Okay, time for our first little detour off that main path. What happens when something is technically part of the GST system, but you're not charging 15%? This is where we run into something called zero-rated supplies. Now, listen up, because this bit is super important. A zero-rated supply is still a taxable supply. It's in the club. The tax rate is just, well, 0%. And here's the golden rule, the thing you have to remember. Because it's still in the system, you can absolutely claim back the GST on any expenses you had in making that sale. That's huge. So what are we actually talking about here? Well, the classic example is exporting goods. You sell something to a customer in Australia, that's zero-rated. Another big one is selling your entire business as a going concern to another GST-registered person. And as we'll see, it also pops up a lot in certain property deals. All right, let's take our next big turn in the maze. And honestly, this is the one that trips a lot of people up. We're talking about exempt supplies. These are things that aren't just taxed at zero. They're completely outside the world of GST altogether. Okay, let's just stop and look at this for a second, because this is probably the most important comparison we'll make. Think of it like this. Zero-rated is inside the GST club. You file it on your return, and you get to claim your expenses. But exempt? Exempt supplies are not even on the guest list. They're totally outside the club. You don't charge GST, but, and this is the kicker, you cannot claim back GST on your costs for it. Getting this right will save you so much grief, I promise. So what kind of things are outside the club? The biggest one is renting out a house or an apartment, long-term. The landlord doesn't charge GST on the rent, which sounds great for the tenant, but the flip side is that landlord can't claim back the GST they paid on, say, fixing the roof. Financial services are another one. Think bank fees, interest on loans, all exempt. It's a totally separate lane. Okay, so we've covered the main road and the two biggest detours. Now let's zoom in on a couple of specific spots in this maze that are, let's just say, notorious for being a bit confusing. And number one on that list, property. This is a biggie. We're talking about huge amounts of money, so making a GST mistake here isn't just a small oops, it can be a financially painful disaster. So how do you get it right? Believe it or not, you can cut through a lot of the complexity by asking just a few simple questions. The first one is all about the seller. Pretty simple. Are they registered for GST, and is selling this property part of their normal business? Okay, question number two, we flip it around and look at the buyer. Same kind of deal. Are they registered for GST? And are they buying this property to use in their own GST-registered business? And finally, the last question, and this one is often the clincher. Is the buyer, or someone in their family, planning to live in this property as their main home? And that's pretty much it. Your answers to those three questions will point you in the right direction. They'll tell you if the deal should be zero-rated, which happens all the time when it's one business selling to another, or if you've got to stick with the standard 15%. It's like a cheat sheet for a really complicated process. Let's look at another really unique situation in New Zealand, koha. When it comes to tax, it all boils down to one idea. Is it an unconditional gift? Basically, the tax office wants to know if it's a genuine gift with no strings attached or if it's really a payment for something. And you can see the difference really clearly here. If money is given during a tangi or a wedding, that's seen as a true unconditional gift, no GST. But if a group pays a koha specifically to hire out the Mariah for an event, well, that's not really a gift, is it? That's a payment for a service, and GST has to apply. It all comes down to why the money is changing hands.
So, we've made it through the maze. We've seen the main highway, the big detours, and a couple of those really tricky intersections. The big question now is, how do you pull all this together and actually use it in the real world?
Think of this as your mental map for GST. Your starting point should always be, assume it's 15%. That's your default. Then, run through a quick checklist. Could it be zero rated, like an export? No? Okay. Could it be exempt, like residential rent? And if you're dealing with something huge like property, pull out that 3-question compass we talked about. And finally, there's the last and honestly the most important step of all.
And this isn't just us saying this. This is straight from Inland Revenue themselves. Making a mistake with GST can be a real nightmare to fix, and it can be expensive. So please don't guess. If you have even a tiny bit of doubt, talk to a tax advisor. Seriously, think of it as an investment in your peace of mind, not just a business cost.
So, now that you have the map, we'll leave you with a question to think about. What part of this GST maze are you going to tackle first in your own business? Maybe it's figuring out your exports. Maybe it's that property deal on the horizon. Or maybe it's just feeling confident you've got the day-to-day basics down pat. Whatever it is, I hope this has given you a clearer path forward.